India's startup story has spent the last 2 years walking a narrow line between ambition and caution. After the funding excesses of the past cycle, 2024 was defined by restraint and selective risk-taking. Capital did not disappear, but it became deliberate. Against that backdrop, 2025 stands out as a year of quiet but meaningful progress. Fewer headlines, more substance. This video looks back at how India's startup ecosystem evolved through the year, the funding cycles, the corrections, the return of IPOs, and why growth, not hype, became the defining theme. Ladies and gentlemen, let's dive into it. 2025 was not just another year of numbers and deals, it was a raw, unfiltered drama of explosive highs, punishing lows, and a comeback that refined what growth really means. The year burst open like a firecracker. Right from January 1st, a massive $4.7 billion in private equity and venture capital money comes flooding into India, marking a whopping 37% jump from the end of 2024. We are talking game-changing raises like Infra.Marketing securing $121 million. Add to that Startup India's 9th anniversary celebration on January 16, where we crossed over 2 lakh recognized startups, created more than 21 lakh jobs. The Commerce Minister Piyush Goyal was out there championing the rise of startups from Tier 2 and 3 cities. The year opened with conviction, unstoppable energy. And then the Finance Minister Nirmala Sitharaman steps up with a transformative 10,000 crore fund of funds announced through SIDBI, giving startups the domestic firepower they desperately needed. The fire keeps burning through the first quarter. But let's not sugarcoat it. Geopolitical storm clouds gather fast. US-China trade tensions escalate, Middle East oil prices spike, and suddenly logistics and clean tech companies are facing 15 to 20% higher costs on imports. It's a wake-up call. Global chaos doesn't care about your ambition. However, India's ecosystem charges forward, proving we can handle the heat. April brings the glitz with Startup Mahakumbh at Bharat Mandapam, drawing over 1 lakh innovators, investors, and dreamers hyped on AI, fintech breakthroughs. But then, boom, the Blue Smart scandal explodes. We are talking serious governance failures, allegations on fund misuse, boardroom battles, and echoes of Byju's collapse that make every investor in this space hit pause. By the first half's end, the numbers tell the brutal story. Tech startup funding drops 25% to $4.8 billion. Overall P and VC at $26.4 billion across 593 deals, down 18.5%, with the seed stages getting hammered by 10 to 39%. Bengaluru sneaks ahead of Delhi NCR in funding share, but smart VC money climbs 41% to $6.8 billion by betting only on proven winners. I believe this wasn't a crisis, this was cleansing. The weak links snapped, forcing everyone to prioritize profitability over endless partying. Tough love, but it built a stronger foundation. And then July flips the script completely. Inflows hit $4 billion and exits skyrocket to $9.2 billion. That's a 267% surge. Then Q3 detonates with $11.7 billion across 369 deals. No question, this was India's domestic muscle flexing, outsmarting the global funding freeze. The opinion here is very simple. When the world tightens belts, India loosens up with homegrown smarts. That's the edge we own. October cements the hero's journey with another 5.3 billion inflows, highlighted by new vehicles like Bharat Value Fund 3. The absolute knockout punch was Dalal Street delivers a record 18 startup IPOs, pulling in 41,248 crore rupees from big names. The second half of 2025 marked a decisive shift for India's startup ecosystem. Capital returned with intent, public markets reopened, and growth came with far greater discipline. This phase will likely serve as the stabilizing base for the next cycle. As 2026 approaches, the ecosystem appears better capitalized, better governed, and more selective in ambition. In our next video, we will break down where capital is likely to flow, which sectors could lead, and what founders and investors should realistically prepare for. Stay tuned for part 2.